Shalom, everybody. My name is Junilyn Brady, and I'm going to continue the discussions of our topic number two, capital structure decisions, under our subject, advanced corporate finance, to be presented to Dr. Noel B. Hernandez and to you, my fellow classmates. And over here, I am tasked to do letter B, which is the types or the four different types of capital structure. But before I go through the four different types of the capital structure, I'm going to share to you a recap of what is capital structure. So, to answer what is capital structure, is that it refers to the amount of debt and equity required to finance a company, often expressed as a debt to capital ratio or debt to equity ratio. In corporate finance, equity offers greater flexibility and is more expensive than debt. Debt represents an expensive source of capital that requires a company to make a fixed and obligatory payments at some future date. So a strong capital structure indicates low debt and high equity, making it an ideal choice for investors. So, investors can often gain insight into a company's assets and liabilities through its balance sheet. So, right here, let, let me share to you right now the different types or the four different types of capital structures. So, I'm going to start with the first one, which is the equity capital. So equity is the difference between a company's assets and liabilities and represents the shares of ownership in a company. And there are also several types of equity, which um, I am also listed in here. The first one is shares. Shares refers to units of partial equity ownership in a company. Shareholders often have voting rights and can take decisions in selecting the company's management. And another one, and under the equity capital, is also the equity futures. So, an equity future is a financial contract in which the parties agree to buy or sell and or to buy and sell the underlying at a predetermined price in the future. So a buyer of an equity futures contract makes a gross profit when the value of the contract increases at expiration and a gross loss of. Again, a buyer of an equity futures contract makes a gross profit when the value of the contract increases at expiration, a gross loss if it decreases, while a seller makes a gross profit when the value of the contract decreases at the expiration and a gross loss if it increases. So the next one, it is still under equity capital, is the equity mutual funds investments. Mutual fund schemes invest their assets in stocks of different companies depending on their investment objective. So their performance depends on various market conditions, which makes them risky yet a source of long-term wealth creation. So that's the first one of the capital structure type. It is an equity capital. And the second one is the debt capital. So we know that a debt is a borrowed money that has to be repaid at a future debt at a future date, which or with interest. So debt providers do not participate in the decision making of a company. There are several types of debts, which include, I know we are all familiar with this, bank loans. So, bank loans are a common form of debt financing. So, over here in America, um, we know that credit card is very common. In fact, my husband applied a credit card for me already just like 2 months ago, and so far I'm kind of like not spending a lot of it because of course you're going to uh, pay a certain amount at a certain like date. So if you also like overspend or almost spend all the money in your credit score will also go low, which is not good for your status here. So, as much as possible, we are trying to grow our score credit in our credit card or in our banks. And the next one is the debentures. They are types of bonds or debt instruments backed by the reputation of the borrower instead of collaterals. They help companies fund future expenses and carry high risk, yet high rewards. And the last one is bonds. Bonds are loans that companies, governments, municipalities, or other organizations take out, funded by investors, to purchase the bonds. It is a way for borrowers to raise money from investors who are willing to lend them money for specified periods. So it's very like common in a government, or let's say in the Philippines. There are like a lot of investors going to the Philippines because they know out of their money, specific establishment can like it's a win to win situation. They can earn money from it, and at the same time, the organization also can earn money with it. But it's like a big investment, and also risky. It's why it needs to have a lot of research. And the third one for our capital structure type is the financial leverage. So, leverage in finance refers to borrowing funds to purchase assets with the expectation of high future profits. But then, since it's high future profits, it's also very risky. That would exceed the cost of borrowing. Leverage helps in multiplying the relatively small amount of money needed for borrowing into large profits. Financial leverage is the extent to which a company can use fixed income securities and preferred stock as part of its capital structure, which can help enhance their profits. And the last one we have in here, the optimal capital structure. So, an optimal capital structure is a combination of debt and equity financing that minimizes a company's weighted average cost of capital while maximizing its market value. It focuses on maximizing profitability and flexibility. Optimal capital structure also maximizes risk and dilution of control of the companies. So usually it happens with like big companies, and not really, for me it's not for like individual capital structure. It's for like big companies or organization. So that's it for my topic uh, this time, and I'll see you on our next subject. Thank you so much for your attention, and God bless us all.